Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. It's also March 10th. Hey, sorry for late reporting today. I've had some internet issues, so we're kind of reporting about three-quarter way of the day here. So it's the afternoon here on the West Coast time. So my apologies. We got probably about another hour or so until the market closes. So, but we'll go ahead and jump into it, and hopefully this will help you guys out still. Um, Today we had the big numbers here. We had the non-farm payrolls brought to you by the Labor of Statistics, Bureau of Labor of Statistics. Excuse me, I'm having a hard time getting that out. So January and December were actually revised higher, about 9,000 jobs. So the January number was revised higher to 238,000 new jobs created. Now, forecast for February was supposed to be 221,000 new jobs created and went up to 235,000. So pretty much in line, a little bit higher, but in line where we were at. I think some people thought maybe a hot number like the ADP when it came in over 300,000. I think they thought maybe it might come in like that, but still pretty much kind of in line to expectations. Now, we got the unemployment rate. We had a 4.8% back in January, and the forecast shows it coming down to 4.7, and it did come in right at expectations at 4.7%. Now, one of the interesting things about the employment was we got the labor force improvement. So it's up to 63%, which is the best we've seen in about a year, basically. So it's the year's best, and approximately at 63% when you got full labor force participation rate. And obviously 63% is a good rate right there. We also got the average hourly earnings. So people did see improvement here. So we had previous January at 0.1% increase, and the forecast was supposed to go up to 0.3%, and it came in at 0.2%. So from January 16 to 2017, it was only up 2.6%. So from February of 16 to 17, it jumped up to 2.8%. So people are making a little bit more money, which is obviously a good sign. Also, we just got to kind of keep an eye on that, as we know the Fed will be watching that, as that does create inflation numbers as well. So that's something to keep an eye on, especially after the last election. I think a lot of people I think there's areas out there that are trying to raise the minimum wage. Some areas I think are as much as $15 an hour right now. So of course, with that wage inflation, you're going to see higher inflation coming up above. That's going to help create higher inflation, where it's going to raise the cost of basically everything down the board there. So anyways, we're not getting into it too much here, but let's go to the headline news. The stock market's up. It was settled. It's not up a lot. It was fine with the numbers. It didn't disappoint, nor did it come in really stunning. So it was fine with all that. Oil has continued to drop. It's down below $50 a barrel. It's down to about 48 and change right now. Now, one of the big things right now is the 10-year yield, the 10-year Treasury yield, and earlier this morning, when it first opened up, it came in at 2.62%. That's the magic number we're kind of watching for. Anything above 2.61%, bond market could really drop down quite a bit and leave room. But since then, this morning, it's pulled back and it's down to about 2.58 right now currently. So we'll have to kind of keep an eye and see where it goes. But speaking of bond market, here's where we are. Now, don't get too scared about this. We had a bond rollover last night after the closing, which was a 22 basis points for it. So basically, that would bring us up to just above this line here of support. Now, we came in a little bit lower here as the second line of support here. Now, these levels, we actually haven't seen these levels since December, mid-December. These were the lowest points that we saw, and that previous point from that, the lowest time we saw these were basically right around May of 2014. So these levels are basically the levels that we saw back in May of 2014, and then rates got better. Now this time we're not expecting to see rates. Now we might have a slight improvement, but we won't be seeing the levels most likely what we previously saw, like just before the elections. Most likely those rates are basically gone until the next cycle. But as of right now, if anything, we're expecting, because the economy is improving, that we're going to see rates start rising now as we move forward here. So right now, rates are a little bit better than where we left off. Yes, it was obviously a good sign, so we like to hear that. Again, I'd be a little cautious. So the nice thing is we're past the jobs numbers. Jobs numbers are past. The next hurdle next week will be, of course, the FOMC meeting next week. So they are expected to raise it 0.25% on Wednesday. So keep an eye on that. See how the bond market reacts to those news right there. So that'll be the big one next week. All right, folks, I hope you guys have a great weekend. But if you guys want to get more updates throughout the day, just come over to Twitter. I can be found at Mike Bjork. I do post throughout the day, the different points that pop up. So you guys have a great weekend. We'll look forward to see you guys on Monday. Thanks for watching. Bye-bye.